Something unusual is happening in the crypto markets, and if you are watching prices day after day, you can feel it before you even look at the charts. Bitcoin is not collapsing in panic, and yet it is falling. That is the first signal that tells experienced observers like us that this is not a normal correction. When markets drop quietly, when liquidity thins without headlines screaming catastrophe, it often means that something deeper is unfolding beneath the surface. I want you to think carefully about that because what we are seeing now is not chaos. It is pressure building in slow motion. Just months ago, Bitcoin was trading near historic highs. Institutional money was flowing in. ETFs were absorbing supply, and the narrative of digital scarcity was dominating financial media. Many investors believed the cycle had entered a stable expansion phase. But markets do not move in straight lines. And the first cracks rarely appear in price. They appear in behavior. Liquidity begins to tighten. Volumes shift. Large holders stop accumulating and begin quietly reducing exposure. You do not see panic, but you see hesitation, and hesitation in financial markets is often the earliest warning sign of a turning point. As we moved into early 2026, those broken signals began to multiply. Treasury yields were climbing again, and that matters more than many people realize. When real yields rise, capital moves. Investors begin to reprice risk. Assets that depend on liquidity, technology stocks, high-growth sectors, and cryptocurrencies start to feel pressure. I have watched this pattern repeat over decades. It happened in the late stages of the dot-com era. It happened during the tightening cycle before the 2008 crisis. And it happened again in 2022 when global liquidity contracted. The mechanism is always similar, even if the headlines change. Now, many of you have heard the claim that the recent sell-off in Bitcoin and cryptocurrencies is connected to the release of the Epstein-related documents. I understand why this narrative spread so quickly. Markets crave simple explanations. People want a single event, a single name, a single moment they can point to and say, that is when everything changed. But financial history teaches us that markets rarely turn because of one event. They turn because conditions were already fragile, and then something, sometimes small, sometimes symbolic, accelerates the process. What we began to see in the weeks before the most recent declines was a gradual unwinding of leverage. This is critical to understand. In modern crypto markets, leverage plays a massive role. When prices rise, leveraged positions multiply, and the system becomes more sensitive to even small price movements. When prices begin to drift lower, those positions unwind, not in a violent crash, but in waves. Each wave pushes the market slightly lower, triggering another round of liquidations, another round of selling, another contraction in liquidity. To someone watching casually, it looks like weakness without explanation. To someone who has studied markets for years, it looks like deleveraging in progress. At the same time, institutional behavior was shifting. ETF flows, which had supported the market, began to fluctuate. Not massive outflows, not a dramatic exodus, but hesitation. And hesitation from large capital pools matters. Institutions do not move quickly, they move deliberately. When they slow their allocations, the market feels it, long before the public understands why. Then came the global confirmation that this was not an isolated phenomenon. Equity markets were showing volatility. Bond markets were repricing expectations for interest rates. Currency markets were reacting to shifting monetary policy signals. When you see multiple asset classes adjusting at the same time, you are not looking at a crypto story. You are looking at a macro story, and macro stories are always larger than any single headline. But here's where the contradiction emerges, and I want you to pay attention to this carefully. While prices were falling, the fundamental structure of Bitcoin had not changed. The supply cap remained fixed. The circulating supply was still approaching its maximum. Institutional infrastructure was still intact. The technology had not weakened. Adoption had not reversed. So how can an asset decline significantly while its underlying thesis remains largely unchanged? The answer lies in liquidity and psychology. Price is not only a reflection of value, it is a reflection of positioning. When positioning shifts, price moves, even if the long-term narrative remains intact. This is why the Epstein narrative gained traction, not because it alone moved the market, but because it arrived at a moment when investors were already uncertain. When confidence is strong, controversial headlines are dismissed. When confidence is fragile, those same headlines amplify fear. I have seen this pattern repeatedly. During the European debt crisis, small political rumors moved entire bond markets because confidence was already weak. During the early days of the pandemic, minor news events triggered massive volatility because investors were already on edge. Context always matters more than the event itself. And so, as you sit here watching these markets, understand what is really unfolding. This is not a single cause event. It is a convergence. Rising yields, shifting liquidity, institutional repositioning, leveraged unwinding, and yes, a wave of narratives that intensified uncertainty at exactly the wrong moment. Markets are complex systems, and when multiple pressures align, the result can look sudden even when it has been building for months. I am not here to tell you what to buy or what to sell. That is not the purpose of this analysis. My goal is to help you see clearly, to understand the mechanisms behind the movement, rather than reacting to headlines. Because the most dangerous thing in financial markets is not volatility. It is misunderstanding volatility. And the final judgment, at least for now, is this. The decline in Bitcoin and cryptocurrencies cannot be explained by a single scandal, a single document, or a single narrative. What we are witnessing is a macroeconomic shift expressing itself through one of the most sensitive asset classes in the world. The headlines may change, the explanations may evolve, but the underlying forces, liquidity, leverage, and confidence, are the real drivers. And until those forces stabilize, the story is not over. You are hearing the name everywhere now. It is circulating in headlines, in forums, in private investor chats, in late-night financial broadcasts. The release of documents connected to Epstein has suddenly become part of the conversation about crypto markets. And I can see the confusion in many of your eyes. Some people are asking whether this revelation changed everything. Others are convinced it explains the entire decline. But when you have spent years watching markets react to shocks, you learn to separate what is emotionally powerful from what is structurally important. Let me speak to you directly, because this is where clarity matters most. The documents themselves did not rewrite the code of Bitcoin. They did not change the supply schedule. They did not shut down exchanges, and they did not eliminate institutional infrastructure. What they did was something more subtle and in some ways more dangerous. They affected perception. And perception, especially in markets driven by narrative, can move capital faster than fundamentals. What shocked investors was not a single fact, but the implication of connections, historical relationships, financial circles, early networks of funding and influence that intersected with individuals who later became controversial. When investors see those connections appear in public discourse, they do not always wait to analyze the details. They react to uncertainty. They ask themselves a simple question: what else do we not know? And that question alone can trigger hesitation, and hesitation is enough to slow the flow of capital. You must understand something about modern financial markets. Reputation risk is now a measurable factor in asset pricing. Large funds, pension systems, sovereign wealth pools, they operate under layers of compliance and public scrutiny. When a narrative emerges that links an industry, even indirectly, to scandal or controversy, institutions do not debate it emotionally. They step back. They reduce exposure. They wait, and when large pools of capital wait, markets feel the silence. I have seen this pattern before. In 2018, when certain technology firms became the focus of global regulatory investigations, valuations did not collapse overnight because the businesses suddenly stopped functioning. They declined because the future became uncertain. In 2001, after corporate accounting scandals shook investor trust, entire sectors traded lower, not because earnings vanished overnight, but because confidence evaporated. Confidence is the invisible foundation of markets, and when it cracks, even slightly, the effect spreads quietly and relentlessly. At the same time, there is another force at work here, and I want you to pay attention to it carefully. Information now moves faster than analysis. Social media, algorithmic feeds, real-time commentary. These systems amplify narratives before they are verified or understood. A headline appears. It spreads across thousands of channels within minutes, and by the time experts begin to interpret the facts, millions of investors have already formed an opinion. This speed of narrative transmission is something that did not exist in earlier financial eras, and it makes modern markets more reactive than ever before. You may have noticed how quickly discussion shifted. One day, the conversation was about liquidity conditions and ETF flows. The next day, the conversation was about documents, names, and speculation. That shift did not happen because the underlying drivers of the market changed overnight. It happened because human attention moved, and attention is a powerful force. Capital often follows attention, especially in markets where sentiment plays a large role in valuation. But here is where the contradiction becomes clear, and I want you to think about this with me. If the revelations were truly the central cause of the market decline, we would expect to see panic, abrupt price collapses, and widespread disorder. Instead, what we observed was something different: structured selling, controlled deleveraging, gradual declines. That behavior does not resemble a market reacting purely to scandal. It resembles a market already under pressure, using the narrative as a catalyst rather than a cause. This distinction is critical. Catalysts accelerate trends that are already in motion. Causes create trends from nothing. Many investors confuse the two, and that confusion leads to poor understanding of risk. When you recognize the difference, you begin to see markets more clearly, and you stop chasing headlines in search of simple explanations. There is also a psychological dimension that cannot be ignored. Humans are wired to search for stories. We want events to have clear villains and clear turning points. A scandal fits that framework perfectly. Rising bond yields do not. Liquidity tightening does not. Monetary policy expectations do not. Those forces are abstract, complex, and slow. They do not satisfy the emotional need for a dramatic explanation. And so, when a dramatic explanation appears, it spreads quickly, even if it only explains part of the reality. As you sit here listening to me, I want you to remember this. Markets are ecosystems of belief as much as they are systems of capital. Belief shapes behavior, behavior shapes flows, and flows shape price. When belief becomes unstable, volatility follows, even if the fundamental structure remains intact. And so the real significance of the Epstein documents is not that they changed the economic foundation of cryptocurrencies. It is that they arrived at a moment when confidence was already fragile, when liquidity was tightening, when leverage was being unwound, and when investors were searching for signals about the future. In that environment, even a narrative, especially a powerful one, can act like a spark in dry grass. But do not mistake the spark for the forest fire. The fire was already burning beneath the surface, slow and invisible, driven by forces far larger than any single revelation. And until those deeper forces shift, until liquidity conditions change, until confidence stabilizes, until global financial pressures ease, the volatility you are witnessing will remain part of the landscape. That is the reality, and it is far more complex than the headlines suggest. Now, I want you to step back with me for a moment and look beyond headlines, beyond documents, beyond speculation, because what is really moving these markets is not a single event. It is the machinery of the global financial system itself. When you have watched markets long enough, you begin to recognize the sound of that machinery. It does not shout, it hums. And right now, that hum is coming from liquidity, interest rates, and institutional capital flows, the forces that quietly decide the fate of every risk asset on the planet. Look first at liquidity, because liquidity is the oxygen of financial markets. When central banks expand balance sheets and borrowing costs fall, money searches for yield. It flows into equities, into technology, into venture capital, and into crypto. That is exactly what happened in the years following the pandemic stimulus cycle. Global liquidity surged, and speculative assets rose together. But liquidity cycles do not last forever, as inflation pressures persisted and monetary authorities kept policy tighter. For longer than markets expected, the flow of easy capital began to slow. Not abruptly, not dramatically, but steadily. And steady tightening can be more powerful than sudden shocks because it changes behavior gradually, almost invisibly. I want you to understand something critical here. Bitcoin today is not the Bitcoin of 2015 or 2017. Back then, it was largely isolated, driven mostly by retail investors and niche capital pools. Today, it is embedded in the global macro system. Hedge funds trade it alongside equities. Institutions allocate to it through ETFs. Derivatives markets link it to broader risk sentiment. That means when global liquidity tightens, Bitcoin feels the pressure just like any other macro-sensitive asset. And you have seen this before, even if you did not realize it at the time. In late 2018, when the Federal Reserve tightened policy and liquidity contracted, equity markets corrected sharply, and Bitcoin entered a prolonged bear phase. In 2022, when interest rates surged at the fastest pace in decades, crypto markets experienced one of the deepest drawdowns in their history. These were not coincidences. They were reflections of the same macro force, the cost of money rising and the availability of capital shrinking. Now, look at interest rates, because rates are the gravity of financial markets. When yields on government bonds rise, investors can earn returns with lower risk. That changes portfolio decisions across the entire financial system. Capital that might have flowed into speculative assets begins to migrate toward safer instruments. It does not happen overnight. It happens quietly, allocation by allocation, decision by decision, until the cumulative effect becomes visible in prices. At the same time, institutional behavior has become a decisive factor in crypto markets. I want you to pay attention to this carefully because it represents a structural change. Large funds do not react like individual traders. They move in measured steps. They rebalance portfolios, adjust exposure, and hedge risk. When institutional flows slow or reverse, the effect is gradual but powerful. ETF inflows that once supported the market begin to fluctuate. Derivatives positions shrink. Volatility increases as liquidity becomes thinner, and the market begins to drift lower, not in panic, but in a controlled descent. Another mechanism you must understand is leverage. Modern financial markets are built on leverage, and crypto markets are no exception. When prices rise, leverage expands. Traders borrow to increase exposure. Positions multiply. The system becomes more sensitive to small changes. Then, when prices begin to fall, those leveraged positions unwind. Liquidations trigger more liquidations. Funding rates shift. Market makers widen spreads. Liquidity pockets disappear. And what looks like a mysterious decline is often nothing more than the mechanical unwinding of excessive leverage. I have seen this pattern in many forms. It happened in the Asian financial crisis, when currency pegs collapsed under leveraged pressure. It happened during the mortgage crisis, when structured products unraveled, layer by layer. It happened in commodity markets, when speculative positions were forced to unwind. The structure changes, the assets change, but the dynamic remains the same. Leverage accelerates both the rise and the fall. Now consider the global environment surrounding these markets. Equity indices have shown increasing volatility. Bond markets have been repricing expectations for inflation and policy. Currency markets have reacted to diverging central bank strategies. When you see synchronized adjustments across multiple asset classes, it is a sign that the system itself is recalibrating. Crypto does not exist outside that system anymore. It is part of it, and it reacts to the same forces. And yet here is the paradox that confuses many observers. Even as prices decline, the fundamental architecture of Bitcoin remains intact. The supply cap has not changed. The issuance schedule continues. Institutional infrastructure still exists. Developers continue to build. Adoption continues in various regions of the world. So how can an asset fall when its long-term thesis appears unchanged? The answer lies in the difference between valuation and narrative timing. Markets do not move in straight lines toward a final outcome. They oscillate, sometimes violently, around expectations about the future. You must remember that price is a negotiation between buyers and sellers at a specific moment in time. It reflects fear, optimism, liquidity, and positioning, not just long-term potential. When liquidity tightens and leverage unwinds, prices adjust, even if the long-term story remains intact. That adjustment can be painful, and it can last longer than many expect, but it is part of every market cycle in history. And this brings us to the most important realization of all. The decline we are witnessing is not the result of a single headline, a single scandal, or a single narrative. It is the visible expression of deeper forces, monetary policy, liquidity cycles, institutional behavior, and leverage dynamics. These forces operate slowly, often invisibly, until suddenly their effects become impossible to ignore. So, as you sit here listening to me, understand what you are truly witnessing. This is not chaos. It is a system recalibrating. It is capital repositioning. It is the global financial machine adjusting to new conditions. And until those conditions change, until liquidity expands again, until confidence stabilizes, until the macro environment shifts, the pressure you see in these markets will remain part of the landscape. That is the reality beneath the noise, and once you see it, you cannot unsee it. And now we arrive at the question that I know is on your mind, the question that always comes at the end of every cycle, every correction, every period of uncertainty. What happens next? I can see it in the way people follow charts late at night, in the way conversations shift from shock to speculation, from fear to anticipation. But if you have lived through enough financial cycles, you learn that the future never unfolds in a straight line, and it never follows the script that the majority expects. What we are witnessing right now is not the end of a story. It is a phase in a cycle, and cycles are driven by forces far larger than daily headlines. Liquidity expands, liquidity contracts, confidence rises, confidence falls, risk appetite builds, then retreats. These movements have repeated for generations. They shaped the railway booms of the 19th century, the roaring markets of the 1920s, the technology bubble of the late 1990s, and the global credit expansion before 2008. Every era believed its situation was unique, and yet the underlying rhythm was always the same. I want you to understand something important. Markets rarely reverse at the moment of maximum fear or maximum optimism. They reverse when conditions begin to change quietly, almost invisibly. When liquidity starts to return, it does not arrive with a headline. When capital begins to reallocate, it does not announce itself. The early stages of every recovery are subtle, uncertain, and often dismissed as temporary noise. At the same time, there is another possibility you must consider. Not every correction ends quickly. Sometimes markets enter long periods of consolidation, moving sideways, frustrating both optimists and pessimists. This has happened many times before. After the dot-com collapse, technology stocks took years to rebuild confidence. After the global financial crisis, certain asset classes remained subdued for long stretches, even as the broader economy stabilized. Time itself can be part of the healing process, allowing leverage to unwind, expectations to reset, and capital to reposition. And yet, even in periods of uncertainty, structural forces continue to operate beneath the surface. Bitcoin's supply remains limited. The infrastructure around digital assets continues to develop. Payment systems evolve. Custody solutions improve. Regulatory frameworks slowly take shape. These processes do not stop because prices decline. In many cases, they accelerate during downturns, when speculation fades and long-term builders continue their work away from the spotlight. But there is also a reality that must be faced with clear eyes. The era of easy liquidity that lifted all risk assets simultaneously may not return in the same form. Central banks are more cautious. Governments carry higher debt burdens. Inflation, though lower than its peak, remains a factor that policymakers cannot ignore. These conditions create a financial environment that is more complex, more selective, and sometimes more volatile than what investors became accustomed to in previous years. I want you to think carefully about how markets behave under these conditions. Volatility becomes normal rather than exceptional. Narratives change quickly. Sentiment swings from optimism to pessimism and back again. And through it all, the underlying machinery of the global financial system continues to turn, slowly but relentlessly. There is another lesson here, one that I have learned through years of watching crises unfold. The events that dominate headlines are often not the events that shape the long-term trajectory of markets. Headlines are loud, immediate, and emotional. Structural forces are quiet, gradual, and decisive. It was not the daily news in 2007 that caused the financial crisis. It was years of leverage building beneath the surface. It was not a single announcement in 2020 that reshaped global markets. It was the unprecedented scale of monetary and fiscal intervention that followed. And so, when people ask whether a single set of documents, a single narrative, or a single controversy explains the movements we are seeing today, the honest answer is no. Markets of this size, markets with trillions of dollars in capitalization and global participation, do not move for one reason. They move because multiple forces converge at the same time, reinforcing one another until the outcome becomes visible in price. As you listen to me now, I want you to remember this moment, not because of the fear or the volatility, but because of the clarity it offers. Periods like this reveal how markets truly function. They strip away the illusion that prices only rise. They remind us that risk and uncertainty are permanent features of financial systems, not temporary anomalies. What happens next will depend on forces that are already in motion, but not yet fully visible. Monetary policy decisions, global growth trends, geopolitical stability, technological adoption, institutional behavior. These are the currents that will shape the next phase. Some of them may shift sooner than expected. Others may take time, but they will shift because cycles always turn, even if the timing remains uncertain. And so the final conclusion, the one that I want you to carry with you, is this. What we are witnessing is not a collapse of an idea, nor the destruction of a system. It is a recalibration, a phase in a longer journey, a moment when the global financial machine pauses, adjusts, and prepares for whatever comes next. The headlines may fade, the narratives may change, but the forces that move markets, liquidity, confidence, and time, will continue to shape the future long after this moment has passed.